The opinions expressed on Two-Way Traffic are those of Darren Coleman and are for general information purposes only. It does not constitute any legally binding engagement between the podcasters and anyone else. Always check with your advisors to obtain your own tax or investment advice. Welcome to Two-Way Traffic with Darren Coleman of Portage Cross-Border Wealth Management. In this series, Darren aims to guide you through the complexities, complications, implications, and most importantly, the advantages of having money and family on both sides of the border. On this episode, Darren talks about the headaches of cross-border remote work with accountant Sharon Conrad of Hansen Cross-Border Tax. Enjoy.
Hi, everyone, and welcome back to another edition of Two-Way Traffic. My name is Darren Coleman. I'm a senior portfolio manager with Raymond James in Oakville, Ontario, Canada. And today I'm joined by my friend Sharon Conrad from Hansen Cross-Border Tax. Sharon, good afternoon. How are you today?
I'm great. It's sunshine and it's wonderful.
Isn't it good? And you're just beginning the busy part of tax season coming up. So you're just before it gets completely crazy, right?
Yeah, I'm used to having a little more snow, so you really don't want to go outside, but I'll take it.
Perfect. Well, take every blessing you can, but you're not going to see sunshine for probably the next three and a half to 4 months, probably at this rate, because you're going to the busy season.
Right. Yeah, that's absolutely right.
So I'm glad we got you, because you've got to worry not just about the Canadian tax deadlines, but also U.S. tax deadlines, because you're one of that relatively small group of tax people that does both countries in one place.
That's correct. So
extra complicated.
And a lot of deadlines. So starting in March, we have deadlines every 2 weeks through to probably June.
Oh, wow.
So
okay.
when our U.S. counterparts are April 16th sipping margaritas, we're still working hard at the Canadian taxes.
Still grinding it out. Well, good for you. So today we have many clients that we share back and forth, because you guys really are experts at helping people to navigate that complexity of being and having money or family in both countries. So while there's lots of situations you and I have seen and encountered and worked on, let's just deal with maybe a couple of common ones that you trip over a lot and we see quite a lot. And the first one is one that actually this technology we're using now is really enabled since the pandemic, which is people being able to work remotely. And so while we can work pretty much anywhere you get an internet connection, if you have a knowledge-based job, one of the things that we're seeing is people saying, well, look, if I can work anywhere, then why can't I work for anybody anywhere? So are you seeing a rise of people in Canada saying, look, I've got a job offer, or I'm looking to get a job offer in the companies in California or Texas or Colorado, but I want to stay in Toronto. I want to stay in Vancouver. I want to stay in Edmonton. I don't know why you would, but I'm just as an illustration. Is that a fairly easy thing for people to do, to say, look, it's a global job market. I can work anywhere. I've got a laptop. I'm good. I can take that job in the US. Is that a pretty straightforward thing to do, or is it more complicated?
On its face, it seems like it's pretty easygoing. You get to travel. You see all those pictures of people with their laptops on the beach. I personally don't know how they do it without getting sand
everywhere. Yeah.
Keys, but hey, if you can do it. But when you start to dig into the layers, like an onion, you're going to cry.
Okay.
And that is basically because there's just so much complexity. I mean, you take aside the immigration, which I'll leave to the lovely immigration lawyers and specialists, but it's not as simple as just packing your bag and going to Florida. You have to have a certain immigration status to go in and be able to work. And even though you're working from home, there are rules that you have to watch for.
And I think that's a common misconception people have, right? Is they think, well, because I haven't moved, I can take that job. It's like, no, there's still an immigration and tax consideration for you working for that U.S. employer.
Yep.
It's not that simple.
It's not. And I mean, obviously, the contracts that you're getting out of, I work with a lot of people in California, and those contracts are very lucrative. The issue is, how are you going to report this income to the tax folks? And how are you going to pay your taxes?
Right.
And so what we see is one of two ways. The first is, I'll hire you as an independent contractor. I don't have to worry about any withholding. You deal with it on your own. Um, and you work from Canada. You might come down to California a couple times for meetings or what have you,
Right.
and that's the end of it. Probably not technically correct from a labor law point of view.
But common, right?
Yeah. And this gets, here in Ontario, I know this gets a lot of the employment lawyers worked up because, you have to look at the actual relationship. It's not necessarily what it boils down to on paper. And, I'm always cautious when I get these agreements to look at. The first thing it says is employment agreement. And well, how can you have an employment agreement if you're an independent contractor?
Right. And of course,
Right?
see, in Canada, they'd look at that and say, well, are you really running a business? Because we've seen people try that even without the cross-border complexity of saying, well, I'm not going to be an employee. I'd rather be a contractor. I think I'm entitled to more deductions. But if CRA looks at it and says, well, you're actually not, you are a de facto employee, then you'll find yourself in a whole world of trouble. So the same thing is for a US employer, right?
Yeah. There's the issue of deductions, right? I mean, if you're an actual employee when it comes to common law, then your deductions are limited. And CRA is not, it's not their first rodeo, right? They've been around the block. They look at these home office expenses. They look at, whether or not you have a declaration of employment. They're starting to ask for employment contracts now. And so it really, the worst case scenario is they kick out all your deductions and you owe all the tax.
Right.
Some people say, well, if I incorporate, I'm safe. Well, no, not really, because there's this personal services corp type business that it actually ends up being worse for you, because not only do you not get deductions, but you also don't get the advantage of the small business deduction. So you're paying tax at the general rate. You may, in some cases, have an excise tax, right? They may penalize you for that. So, you have to be very, very careful. If you are not out in the market, you're not, marketing yourself, you have one client that you work 100% for, and that's all. And it doesn't matter if you're working or not working. You get the same amount in your invoice every month. That's starting to sound more and more like an employer relationship. And, CRA, as well as a lot of the states in the US, are really looking at that. California is one of the more aggressive states, where they say, okay, if you're an employee and you're not working in the state, you can exclude that employment income from your tax return. We're not going to tax you on that. But if you're an independent contractor and you have a client in the United States, it doesn't matter if you're working in the Antarctic. You're going to be paying tax in California on that income. That came out of several years ago. There was a case that I believe it was either Uber or Lyft. I know the Hollywood folks were kind of concerned about it, because most of the writers and producers, they're all independent or they have their own business, but
it's a California-based economy really for them, an industry.
That's right. And the production companies are usually in California. So all of their income, even if they didn't step foot in California, would be subject to California tax. And, from a Canadian perspective, well, that income is not taxable under the treaty in the United States. So then you could have a risk of getting your California tax disallowed. So there's a lot of issues with that, working remotely from Canada. It sounds easy. It sounds like a good thing. But if you're doing it as an independent contractor, but you're really an employee, it's, I wouldn't recommend it.
And it's a problem also for the employer, because the employer, if it's a Canadian employee, they've got to do CPP contributions and other payroll related taxes that the US employer wouldn't really necessarily know how to do that.
that's why they say, oh, well, I don't want to get into the Canadian payroll, so let's do it as an independent contractor.
Right.
And that's the other issue. Actually, a lot of people that I talk to don't make the connection that it doesn't matter where you're getting your pay deposited, where your home office is. It's where you're physically rendering those services as an employee. That's where you have to look at who's going to tax you first.
Right.
And yeah, there's the Canada-US tax treaty, and there's other tax treaties with other countries as well that minimize the double tax, but it's not going to completely go away. And in some cases, there's steps you have to take to get to that point, right? If you want treaty exempt income, you have to set up your payroll properly, right?
Right.
You can't work for a U.S. company, get paid from a Canadian company and say that it's treaty exempt income. CRA is not going to allow that. And then you're right, you have your CPP, your EI, and through the pandemic, we saw a lot of that because, now I'm out of work, and guess what? I have no employment insurance benefits
because
right?
I haven't been paying into it. Yeah.
So that's a big issue. Another is most of the states in the U.S. are at will, so that means that if they don't like the tie you're wearing, they can fire you, and
Yep.
you can try and sue and see how that goes, but it's not, you don't have the protections in the US that you have here in Canada. And that's where you need to consult with an immigration lawyer to protect yourself, because you may think, oh, well, you have to provide X weeks of notice. Well, not really.
Maybe not,
if
right.
you don't negotiate it up front, right? Maternity leave is another big one, right? I mean, in the US, you got 2 months, 3 months.
I thought it was like
tops.
20 minutes and you got to be back to your desk, something like that. It's
basically
so short.
have the baby and come back, right?
Yep.
Most of the kids are born at the office.
That's right. If you can have it on your lunch break, that's even better because it doesn't need up any extra time away from the desk. But
that's right.
So
your unpaid lunch hour.
That's right. So I guess one of the things that when someone is looking to take that employment opportunity in the US, there's a whole variety of areas, right? We talked about immigration. Like, can they take the job? Are they allowed to take the job? Do they need a visa? Do they have the ability to work in the US, even if they're going to reside here? But then the tax part's also complicated. I've met people that say, well, I'm going to work for that company in the US. I don't have to pay Canadian taxes anymore. Well, that's not right because you're taxed on where you live.
And you get people that are trying to be creative too, right? So you have a couple, they're living in Canada. Oh, I'm going to take this job in California. I'm going to get a house down there. I'm going to live there, but I'm going to come back on the weekends. So I'm not going to be a resident of Canada. Check a little further.
Yeah.
You're married, you got kids, they're going to school.
Got your driver's license, you've got a curling club you belong, all that stuff. You're actually resident here. So just because you have that home,
that's right,
doesn't mean you're not a resident here.
You still have the benefit of paying the high rate of tax in Canada. Now,
isn't that great? You make that sound like a good thing, but I sense a little bit of sarcasm.
Maybe just a little. The sarcasm gets a little more intense as you get closer to April 30th.
Fair enough.
People make assumptions, right? Or they make an assumption that I can pick whatever day I want to leave, be considered not a tax resident of Canada. And I'm like, it doesn't work that way. Canada has a fact-based residency determination.
Right. So let's say that person does take that job in California or Texas and says, I'm actually really going to leave. I'm going to relocate down there. Mm-hmm. The immigration rules, I've done all the stuff I've done. So there is a mechanism, there is a process to stop being a tax resident of Canada, right? And this is this idea of, as you're saying, this idea of severing some of your ties to Canada to say, I don't live here and I'm going to prove it. So what are some of those things that you have to show, kind of demonstrate that I'm not here anymore?
Well, unlike the U.S., where you hear a lot in the media about citizenship-based taxation.
Right.
Fortunately, Canada hasn't got there. We're not there. We're residency-based. So there's no particular definition of resident for individuals. It's based out of several court cases throughout the years, and we look at various tests and basically, we look at the factors the ties that you have to Canada.
And this is just to interrupt. This is an important consideration because Americans are taxed based on citizenship. So if they no longer want to be an American citizen, there is a pretty thorough and prescribed process to renounce or relinquish your citizenship. But Canada's tax based on residency. So you can stay as a Canadian citizen. You just have to go through this process of saying, I'm not a resident anymore. And that's not a specific list of things. It's a fact pattern. So you kind of have to so it's a little more subtle, isn't it, to really establish this?
It's objective in some cases.
Okay.
And there is some gray areas, right? I'm not going to say that's cut and dry. It's not. Where I see a lot of confusion is with
The home. Yeah, your principal residence.
Permanent residency. So we have a lot of clients that say, oh, well, I've been in Canada for 3 years, but I just got my permanent resident status, so I'm a resident now. No, you were a resident when you moved to Canada 3 years ago. And so I look at it, the justice scales.
Yeah.
You got to balance it out. And you start at sort of balanced, right? And then if you have Canada and the US on either side, well, then you start weighting down one side, and one side will come out on top, usually. And so the more significant factors that have the most weight would be your principal residence, where your spouse is living, your dependents, where they're living. So if they're enrolled in daycare or school in Canada, we're in Ontario, so if you have OHIP, if you have a Canadian driver's license, your cars are all registered to Ontario, your banks are Ontario, your address that you give to everybody, your employer included, everybody, from your bank to your lawyer, is a Canadian address.
You're Canadian.
Chances are you're going to be a Canadian resident. And the thing is, a lot of people say, well, I was told I can't have a bank account in Canada if I want to be a non-resident. That's not an issue in most cases. What's the issue is you have to let the bank know that you're not a resident anymore.
Right. Yeah, if you're still keeping Markham, Ontario on your address, it's kind of hard to say I'm not in Ontario anymore because that's what you told the bank. So you're right. Yeah. You can have a Canadian bank account. Investment accounts are a different animal, so we can talk about that a bit later. Yeah. But I guess the idea is if somebody is in that situation, they really need to sit down with someone like you and say, here's my fact pattern. And you can kind of say, here's the highlight, like don't have your home in Canada anymore. Don't have your Canadian driver's license. So there's a bunch that are kind of the highline items, right? And then there's probably more subtle things that come through that conversation to say these are the factors that if CRA looks at it. Now, is there a way to get an adjudication on this before you go? Is there a way you can actually ask the tax authorities in Canada to say, like, this is what I did. Am I good? Or do you just wait for them to ask you?
That is a very good question. And my response to that is probably you don't want to go down that route.
Of asking first.
Yeah, of asking first. And the reason for that is there's a couple of forms on the CRA website. There's a determination for leaving Canada and arriving in Canada. And the thing is, one, it takes the CRA quite a while to respond to you. Okay. So you could be gone quite some time before you actually have a decision. And usually once CRA makes the decision, it's in stone, right?
Okay.
So you have no flexibility with respect to, okay, well, you know what, my house is closing on the 12th, but I don't want to be subject to the 25% withholding tax on the sale price. So I'm going to delay my departure by 3 days, right? If you write that down into an ask for basically the CRA's permission or their determination, their opinion on that, it's going to be hard to change their mind if nothing significant has changed, right? Because you get a letter and they say, we consider you to be a non-resident or a resident as of this date. And then your tax returns are filed accordingly. And you lose that flexibility. And things like, sometimes those questions are a little vague. And some people are answering them, from the point of view of today versus, no, that's what happened 3 months ago.
Okay.
Right. And so sometimes the residency date gets a little bit
It's ambiguous.
Yeah, because it's like, oh, well, I thought they were asking about like what it is right now, as opposed to when these events actually happened. And I've had clients who, you know, let's say they go to the US on a student visa and then they decide later that they're going to stay. Well, they're talking about their residency determination about today versus when they first went, and when exactly is the trigger. And those sorts of nuances can get you into a lot of trouble.
Right.
And you may get a result that you don't want. Good example, TFSAs, right? So I go down to the US, I'm a student, I'm contributing to my TFSA, and then all of a sudden I get a job offer. I'm going to stay here. I asked the CRA for a residency determination. They say it happened when I first went down to start studying as a student. And guess what? All those contributions now are subject to a 1% penalty tax per
Wow.
month.
And that could have been in several years have gone by.
Yeah. Whereas, you know, were you really, because you know, you were on a temporary visa, you were a student, you were still coming back and forth, going home, you know, you were living in different accommodations every semester or every school year. So there's different nuances to that, right? And there's consequences for just answering these questions kind of without understanding the consequence behind them and what CRA is actually looking for. You know, if you don't agree with the CRA, you can also go to a competent authority, which is pretty much like it's set up under the bilateral treaties, right? It's because you're dealing with the tax treaty, so you're looking at the residence between two countries in this case. You can go to that competent authority and they would say, which country are you ultimately going to be a resident of? Because at the end of the day, really only one country has the right to tax you as a resident.
Right. So this is good. So I think the key thing is don't play the home game. If you're in this idea of moving, this is so complicated and so easy to make a mistake. Just filling out the forms online could actually be the worst thing to do. You really do need someone that can guide you, right?
You could get into a lot of trouble. And we have a lot of clients that come to us 2-3 years later. Anyone that's watching that has a foreign tax credit knows that every year you're going to get a letter saying, I want support. And most of those individuals respond. Some of them don't because they didn't update their address, so they didn't get the letter. And what ends up happening is, you know, they've been filing as a resident the whole time they've been living in the United States and just claiming a foreign tax credit and paying the difference. And they come to me and I'm like, why are you even filing if you haven't lived in Canada for the last 5 years?
Right. You should have been non-resident by now.
And that's where they kind of get confused with, you know, the permanent resident status versus immigration versus tax residency. And, you know, they're happy when you can get it fixed for them and they're not getting collection calls every 3 months and things like that. But those are some things that, you know, if you don't understand sort of the rules, the residency rules at the beginning, it has a trickling effect that goes and it impacts everything else that you're going to be doing.
Wow. Okay. So let's close it there for the people that are moving to the US, taking a job in the US, get some assistance. Let's now move to someone at the other end of their career where work is coming to, you know, its conclusion. And we see a lot of this. We'll call that the returning Canadian, the person that's, you know, spent most of their working life or a big chunk of their working life in the United States. They decide, you know what, I'm going to come home to Canada. I may be on a green card or on a visa or whatever. I'm going to come back to Canada and establish my life here. Anything they need to be worried about or thinking about as they return home?
There's a lot they need to think about. And, you know, tax is one of many things that they need to think about. So if you're returning to Canada, obviously you need to consider the increase in tax that you're going to pay. not just income tax, but the good old HST. A lot of the states have some sort of sales tax, but it's nowhere near 13%.
Right, what it is in Ontario. And then we got the carbon tax on all kinds of things that's been added in, and sometimes it's visible, sometimes it isn't. Yeah, but it's generally a higher tax environment across the board, right? So they need to factor that into their retirement planning, their retirement income planning.
And if you're coming from a state like Texas that has no state personal income tax, and your top marginal rate is 37%, and you're filing jointly with your spouse, and you make $600,000 a year, guess what? Now you're going to have $600,000 of tax income on your return if you're the only one that's earning that income, and it's not going to be 37. It's not going to be 37%.
So that's part of it. They have to adjust for what's that cost of life going to be, right? They've also got to worry about, let's say they're on a green card, for example. They no longer wish to have it. Now they've got to go through a process of, well, maybe I need to pay to leave the United States.
Yeah. And that's where we get a lot of confusion as well, because individuals that were in the US on green cards for 10, 20, 30 years, they come back to Canada and they're like, oh, I'll just let it expire. Well, guess what? That doesn't work for tax.
Right.
For tax purposes, you are still going to be considered a resident alien and subject to worldwide tax on your income and all of the foreign reporting nightmares that go with it, as long as you have that green card. If it expires, that's not an expatriating act. You have to formally abandon the green card or surrender it.
Right. So just because it expired doesn't mean you're off the hook paying taxes and filing taxes in the U.S. You still have to do it.
That's right.
Yeah.
Yeah. And, the whole point of the green card is that you're going to be living in the U.S., right? So if you're living abroad, you can talk to an immigration lawyer, get a reentry permit, but those are usually only good for up to 2 years. And so what ends up happening is, especially for people that are continuing to cross the border into the, snowbirds, they want to be snowbirds. If they enter, they could get that green card taken away from them at the border.
Mm-hmm.
Guess what? You've just expatriated for tax purposes. And if you haven't been compliant in your tax filings, or your net worth is more than $2 million, or your average net income tax for the last 5 years is more than $190,000, you're a covered expatriate.
And that's expensive.
And that is a horrible place to be. If you thought the Canadian departure tax was bad, then the expatriation tax is really going to make you upset, angry.
Yeah, we had a conversation recently with John Richardson, who's a tax lawyer in both countries, and he talked a lot about how shocking that cost can be, because things like pensions are all put in there. So the number can be gigantic. We've actually seen, and John and I talked about this, and we've done this together, is people that have that green card that want to come back to Canada, it's sometimes better for them to then get full citizenship in the US instead of relinquishing the green card. So it's like, we'll go deeper into the ocean now as opposed to coming out of it. That might be the cheapest option, right?
And that's for sure. So I do a lot of consulting with people that are planning to come back to Canada. And fortunately, they come to me a lot of times years in advance.
Yes.
Right. And then you can do you have more options available.
Right. You can do some planning around how you do this, right?
Right. Because it takes time to get your citizenship, right? It's not like I can go down, like you're going down to the DMV and you're getting your license renewed, right? It actually takes quite a bit of time to get your citizenship, even though you've qualified for it. And so it's not going to happen in a week or a month or even a year. It might be longer. And so the longer lead time you have, the more you can plan. And so getting the citizenship is a good option, because you don't risk losing your status and end up paying this huge amount of tax.
Right.
I guess the trade-off is that now you have to file indefinitely in
right.
the US.
You're filing US and Canada. Yeah, that's right. So your complexity of filing is high, but you don't have this big sticker shock of this huge exit tax that they'd hit you with.
Yeah.
So it's just a trade-off, really, isn't it?
at the end of the day, you're trading off the exit tax for estate tax. But if you're living in Canada, you can get estate tax credited against your Canadian tax. But,
Right.
Expatriation tax, like gift tax, it's just a cost.
Right.
There's no remedy in Canada under the treaty for you to recover that tax. So, and you have a longer window to plan for the estate tax, right?
For sure, yeah.
And you have a huge, a lot larger
That's his exemption at the moment.
exemption.
Right.
Yeah, like right now it's over 13 million. It's not going to stay there, but I mean, it's $2 million. You have a house in Toronto, you're kind of over the limit, right?
Yeah. So that's the thing. Like a lot of people get captured in that covered expatriate thing because the number is $2 million, but that's everything. Like that's home, pension. There's no credits against it. So it's easy for many people to hit that number. So this is why it's a very important consideration. And then there's techniques to lower your exposure to the number if you have time to plan. But let's also change to another situation we see, which is someone's coming back to Canada. They may have been on a temporary visa, so they don't have that complexity of having to relinquish a green card or renounce citizenship. They just said, look, I worked for 5 years in the US or 10 years, whatever it is. I'm coming back. My retirement plans were all in the US. I was on the US payroll. I've got a 401k. I've got an IRA. Can I just merge those to my RSPs? Is that the simple thing to do, or what other considerations do they have?
I mean, you can. I say it's not a given. It's not one of those things like, oh yeah, it's a no-brainer. It is a brainer. You have to think about it. You have to run the calculations. There are benefits for having, your pension plan in the United States. You're gonna pay the same rate of tax on that pension income in Canada anyway,
right.
Whether it's in the United States or in Canada. If you set it up properly and get the proper withholding done, you don't even need to file a tax return in the US when you start to receive your pension distributions. Your 401k is eligible for pension splitting with your spouse. So you do get those benefits. Where you need to be careful is, if it's coming from, for example, a 401k, it's not dollar for dollar that can go into your RSP, right? It's only the portion that you've personally contributed and the related growth. Your employer portion has to go above the room, and it's a one and done type situation. So if you have $1 million 401k and you say, okay, well, I want to put it in my RSP.
Can it just move across? Yeah.
Well, yeah, you might be able to do half of it, but then you have a tax liability of $500,000 at a rate of 55%.
You don't have $1 million anymore. Yeah.
Even with the $500,000 deduction and the 15% tax credit, you're still probably going to end up paying some sort of tax on that.
Right.
The other option is to transfer that to the IRA from the 401k. So you have a rollover.
Yeah, because sometimes the 401k being a group plan, sometimes the employer will let you stay in the plan once you've left the company. Yep. Other cases, the employer's like, nope, you have to leave. So it really is kind of plan dependent on what someone's choices are.
That's right. It's what the plan is going to allow. A lot of it depends on how long you've been with the plan. So, for example, the vesting conditions. If you've only been in the plan for a couple of years, maybe they're not going to let you stay in. Right. But having said that, usually there's an option to roll it to an IRA where you can manage it yourself. The IRAs can come into your RRSP the full value, less the income tax, or you can top it up. You also have to keep in mind your age, right? Mm-hmm. Yes. If you haven't yet attained the lovely age of 59 and a half, then you're going to pay an extra 10% tax. Right.
So that's another clip that goes to your retirement account. And we see this all the time. We regularly get this. So one of the things that, because we're agnostic and we're licensed both in Canada and the US, and it doesn't really matter to me which place the person puts their retirement account, it's what works best for them. We often see people with the 401k that if you can leave it as it is, that's a really important consideration, but sometimes they can't. Often the 401k provider doesn't even know the rules. We had a lady come to us years ago, and subsequently a number of other people from that company, where they worked in Windsor, Ontario, and drove every day for their whole career to work for a U.S. employer. And they were in the 401k with matching. And when it was time to retire, they filled out the form, and the company came back to them and said, "We have a problem." And she said, "What? You're Canadian." She's like, "I know." And they said, "Well, we don't know how to pay you a pension. We don't think we're allowed to. We've had a quick look at Google, and we think the right answer is we can't pay you your pension until you're age 71, and then we're going to pay you all of it at once." And she was like, "So hang on, you're going to make me wait years before I get my money, and then you're going to do a calculation and pay me all of my pension in one check and make me pay the highest amount of taxes humanly possible." And they just said, "Yeah, that's what we think the right answer is." She's like, "I don't think that's the right answer." So fortunately, she found us, and we gave her a different answer, which was roll it to an IRA, because they wanted her out of the plan. But then the person is stuck because an IRA is an American plan, not a Canadian plan. So they can't really walk over to their local Scotiabank, TD Bank, or whatever bank branch and say, "Can I open one?" They're like, "Those are not, we don't have those." And the compliance rules are such that the person will be stuck if they're in Canada, because a US financial institution won't open one for them. So then they're stuck. Yeah. So we can provide a solution to that. But this is an important thing where, as you said, the first thing you need to do is look at, well, what is your math? And there's kind of some pros and cons. And then what we often see is they're also then tangled up to what the financial institutions will do. So we've got a tax thing. We've also got a regulatory compliance issue. So all of this gets very, and what we also find interesting is very few people know this when they move home. This often comes as a bit of a surprise.
When they get that 30-day notice in the mail from their their IRA provider, and it says you have to collapse it or move it within 30 days, and then like, what am I going to do with that, right? You have to be very careful, because your gut reaction is, "I'm just going to move it to my RRSP," but that may not always be the case. I mean, you're losing 10% off the top because of the penalty if you're not 59 and a half. You're going to have the withholding. They're probably going to withhold 30% because now you're back in Canada, not the 15% under the treaty.
Right.
So now you're down to what, 60% of your value that you can put into your RRSP. If you want to get the full value, then you have to find some way to get the cash to pay that other 40%.
Yeah, to top it back up again, right? That's a trick.
And then, a lot of people, which is kind of not really intuitive, but they think, "Oh, well, in a year that I don't have a lot of income, that's the year I'm going to move my RRSP or my IRA to my RRSP.
Right, that's the year I want to do it."
And that's not the year you want to do it.
No, because you need income to offset the tax credits, right? To use the tax credits. So this gets really confusing. Now, the good news is we can resolve that, because we can open an IRA for a Canadian. We've done that for your clients. One of the other things to keep in mind, and I'll share this with people, is that the Canadian banks don't have this option generally. So if you're in the middle of this as a listener, as a viewer, and your banker is saying, "Well, the best thing to do is put it to your RSP," maybe not. So maybe reach out and we can give you an option that they aren't aware of that might be more suitable to you. Because I'm sure I'm not sure. I've already seen, like, CBC Marketplace, for example, has done stories on people going to their local banker and moving it to the RSP and then discovering later, "What do you mean I have a $50,000 tax bill? I didn't know that." So these are not good surprises.
No. And usually I'm the one that has to deliver that message, and it's not a fun message to deliver. If you're coming to me looking for advice after you've already done something, I don't have a magic trick up my sleeve. I can't go back in time, unfortunately.
Right.
As much as I'd like to.
Sometimes we can. If they do it within a short period of time, we might be able to kind of have transactions reversed. But yeah, you're right. By the time they usually find out they're into another tax year, and, "Oh, gee whiz, this is too late. This is not a good idea."
Yeah.
Right. Yeah. So getting ahead of that's the plan.
And so just like, if you have a spiritual leader that you confide in, your financial advisor and your tax accountant are the two that you want to talk to the most. Right.
Exactly. Well, and because my friend from Newfoundland has a good word. He says it's tangly. And these problems is a great word, right? This tangles people up, usually way more than they expect. I'm sure you find that people come to you like, "I didn't know it was this hard." We watch the same TV shows in both countries. My phone works in both places. And they're a little shocked to discover it's like we're two different countries or something. It's a real surprise.
Imagine.
Isn't it crazy?
Who knew? But yeah, I mean, we get those questions all the time, and there's so much mixed information out there. And I mean, the devil is in the details.
Yeah.
You had mentioned cross-border commuters, right?
Mhm.
There's a caveat that if they were a resident during the time that they earned that pension contribution, they cannot roll it into an RRSP above the room. You have to use up your RRSP limit. And, for people that have been out of the country for a number of years, if you're looking at somebody that has been working in the US for, 20 years, comes back to Canada, wants to move that back up here, they probably have very little RSP
Oh
room
yeah,
to
that's almost
use,
non-existent. They can't shelter it. Yeah.
right?
Yeah.
So it's all going to be taxable, unfortunately. And, it's unfortunate that the financial institutions in the States do push them into that sort of corner.
Oh, and we've seen people get the letters. They change their address to Canada, and then eventually the computer catches it. And they get the letter that says either
Yeah.
your account is frozen because we're not allowed to take instructions from a Canadian, or the other one, which is the really scary one, which is you have 30 or 60 or 90 days to move this somewhere else, or we're going to send you a check less taxes and penalties. That freaks people out. Just another warning for people. We've seen this. This used to be the way people tried to get out of the trouble of this, was they just find another U.S. address. They put their neighbor, their cousin, their friend, somebody that had a US address and go, okay, that'll work because now they don't know that I'm not in Canada anymore. Well, the web of compliance continues to do this. And what we're seeing is that the US companies, well, Canada too, but the financial institutions are like, every few years now, we need to update and refresh your documentation. So they want to make sure, because they're trying to catch tax cheats and money launderers and all this other kind of stuff. So they want to make sure the documentation is current. Well, One of the things that they're asking for now is proof of domicile. So you can't just say, well, here's my passport to show you that this is me. They want, well, where do you live? And part of that's because we're seeing in the US differences in taxation. So California wants to know, are you in California or are you in Florida? Mm-hmm. So we're seeing people being told, well, we need your driver's license. We need a utility bill that proves you live where you say you live. And now the gig is up. They're not able to use their cousin's address or whatever anymore. So what may have worked for a long time suddenly doesn't work anymore. Whoopsie.
That's right. And I mean, Big Brother's always watching. There's online banking, right? I've heard that, they're tracking IP addresses, right?
I was going to say, so if you don't have a VPN, you better get one.
Yeah. Right. They can track you if you're constantly logging in from Canada. So, right. It's getting harder and harder to fall back on, well, I've been doing this for the last 20 years, or, this is what my Uncle Bob does. And, right. My friends, you can't rely on that anymore. It wasn't right then. And they've been able to kind of skate under the bar. There's just so much data out there that they can mine and get the information. So it's going to be harder and harder going forward to do those kind of things.
Yeah. And we're seeing more and more compliance requirements, whether it's, the underused housing tax or bare trust reporting. There's so much more complexity. And so if people don't already have a qualified tax advisor, they really better get one, because even living a relatively simple life now has more complexity. It gets more tangly every year, right? So
well, and I mean, it could impact something as simple as your principal residence exemption.
Let's talk about that. This is something that I know we've encountered. So let's say we've got a husband and wife, or any kind of couple, husband, wife, doesn't matter anymore. Person. Are we allowed to say person? I don't know what the pronouns are, but you've got...
Well, if you're in the US, it could be alien.
Could be alien, yeah. So we got alien 1, alien 2, alien. So whatever Zim and Zur are all about, they own a home together in Canada. One of them is Canadian. The other was born in the United States. And in Canada, hey, we sell the house. We don't pay taxes on our principal residences. Is that true, or are they in for maybe a surprise?
They're going to get a horrible surprise when they get their U.S. tax return.
And what's the surprise going to be, Sharon?
The surprise is going to be that they're going to owe tax in the U.S. of somewhere around 24%.
Yeah.
Right?
Yeah.
And the reason for that is because Canada has a very generous principal residence exemption.
Right.
It's unlimited.
Right. So as Canadians, we don't even think twice about this, right? We just go,
No.
you're not taxing my home. I can sell it. And if I've had it and made $1 million, I get to keep the money.
Yeah. And I mean, you're seeing now, I mean, with the last budget, they're implementing more and more restrictions. Like you can't buy a house and sell it within a year.
Yeah, you have to now write down what home did you have and all that kind of stuff. So they're recording all this stuff. But what happened? Why did somebody have to pay tax though?
So in the United States, their principal residence exemption is $250,000 US per person. So if you're married filing separate because your spouse is a Canadian and not a US person, then only the first $250,000 of your share of the gain is going to be exempt.
Right.
The rest of it is going to be taxed as a long-term capital gain. And bonus for those citizens out there, but not only is the income tax going to apply in this case, you're also going to have the net investment income tax at 3.8%, which, was
that doesn't sound like gravy on the fries to me. That doesn't sound like a good thing.
No, it's probably really sour cream.
Not good on your ice cream. So this is something that we often encounter, is that people will ask them, if one spouse is American and they own their home together, we need to have a conversation about maybe there's a different strategy here. So again, more tangliness, more
ugliness. You're right. There are planning strategies around that. We take advantage of the gift tax rules in the US and the principal residence exemption here in Canada. However, with the new trust reporting rules, you have to be careful about bare trusts.
Yep.
And so it gets very tangly.
Very tangly, right. So, I've had you for about 45 minutes today, which is a rare thing given the time of year. So I really appreciate you taking some time and talking with us today, because I know you're an expert at this stuff and we work on a number of files together. And for anyone out listening, if you have some of this complexity and Sharon has time to talk to you, you're a good person to talk to. So thank you for your time today, Sharon. I really appreciate it. And I won't bug you again till May. Okay. Fair deal?
Oh, come on. It's going to be before that.
Probably so. But I appreciate your time. And on behalf of the listeners, thank you very much. For sure. I'm going to have you on again. So thanks for today. And I'll be sending you care packages as you make it through. So you'll be fine.
All right. Lots of chocolate for the team.
Okay. Thanks.
All right.
See you later. Bye-bye.
Bye.
This has been Two-Way Traffic with Darren Coleman of Portage Cross-Border Wealth Management. Thanks for watching and listening. If you have any questions or comments or ideas for new episodes, send us an email at twowaypodcast@gmail.com. And you can find the Two-Way Traffic Podcast on Facebook and Twitter. This series is a production of the Acme Podcasting Company.
On behalf of the Two-Way Traffic Podcast and Portage Wealth of Raymond James, thank you for listening to this conversation. This podcast has been prepared by and expressed the opinions of Darren Coleman and his guests, and are not necessarily the opinions of Raymond James Ltd. Statistics, data, and other information presented are from sources Raymond James believes to be reliable, but their accuracy cannot be guaranteed. This podcast is for information purposes only and is not construed as an offer or solicitation for the sale or purchase of securities. Investors considering any investment should consult with their investment advisor to ensure that it is suitable for the investor's circumstances and risk tolerance before making any investment decision. Past performance is no guarantee of future results. Information provided in this podcast is general in nature and should not be construed as providing legal, accounting, and/or tax advice. Should viewers have any specific questions or issues in these areas, please consult your legal, tax, and/or accounting advisor. Raymond James Ltd. is a member of the Canadian Investor Protection Fund. Raymond James USA Ltd. is a member of FINRA and SIPC. Raymond James Ltd. and Raymond James USA Ltd. financial advisors may only transact businesses in provinces and/or states where they're registered.